Hello, this is George McAllister with MCOL, and I'd like to welcome our listeners to today's podcast session. We're pleased to have Doug Sherlock, Senior Healthcare Analyst for Sherlock Company, joining us today. Doug is here to give us his quarterly insights into financial markets of health plans.
Well, thanks, George. In this podcast, we'll review the performance of the managed care industry for the third quarter of 2021 and year to date. We'll also discuss sector valuation indicators and operating trends. As always, we only use comparable plans in trends, and that convention will be used in the body of this presentation. Trends and valuation metrics is of the 7 continuous plans for year-to-date comparisons. Operating trends include all plans. First, I want to speak to stock prices and the valuation for the continuously participating plans, that is, excluding 5 new publicly traded plans. As of November 16, stock prices for the continuously publicly traded health plans are higher by an average of 30% since the beginning of the year. Similarly, health plan sector market capitalization increased by 22% year to date. The overall increase stemmed from a broad increase among plans that were publicly traded prior to 2021. This compares to the 25% increase in the broader market measured by the S&P 500. Stock prices for all 7 continuous plans gained ground so far this year, led by Triple S at 67%, followed by Molina at 45%, and Anthem at 34%. United Health increased by 28%, Centene increased by 25%, Humana by 8.3%, and Cigna increased by 5%. Valuation metrics were all higher since the beginning of the year, with price to trailing 12 months earnings increasing by 39% to 22 times, and price to operating earnings growing by 71% to 24 times. Price to trailing 2021 earnings was higher by 28% to 17 times. Price to sales gained 11% to 0.8 times. Price per total member increased by 20% to $4,000 per member, and price per risk member increased by 16% to $6,300. For comparisons from our last podcast, the plans compared are all plans, that is, a total of 12 plans. Since our last podcast in August, health plan valuation metrics were all higher. Notably, price to operating earnings was higher by 15%, and price to 2021 earnings was higher by 15%. The average health plan stock prices are higher since the last podcast by 6%, with the health plan market capitalization increasing by 9%. The S&P 500 has gained 5% since August. The biggest gainer was Triple S with an increase of 51%. Its stock price closed at $35.59 yesterday. Guidewell Holding Company, the parent of Blue Cross and Blue Shield of Florida, announced on August 24th a definitive agreement to purchase Triple S for $36 per share, not far from where it closed yesterday. The transaction is expected to close in the first half of 2021. InnovAge had the largest decline of 44%. This PACE plan announced in its fourth quarter 2021 earnings on September 21st that CMS had frozen enrollment for its de novo Sacramento, California center relating to an audit, and that there are 3 additional audits in their Colorado center. The Sacramento center serves 1,500 patients, but at the time of the audit only served 200 patients. As of November 16th, most of the newly public companies declined in value since they went public. Bright Health has fallen by 71%, Oscar by 66%, InnovAge by 63%, and Clover by 56%. Uniquely, Alignment is higher by 32%. On to our review of operating trends. But before I begin, there's a reporting nuance I want to point out. All of the plans, except for InnovAge, are on a calendar fiscal year. InnovAge's fiscal year ends June 30th, and InnovAge's earnings are for its first quarter of its 2022. But we're going to refer to the earnings collectively as third quarter 2021. For the third quarter of 2021, combined ASO and risk membership increased by 45% on average, while increasing by 6.5% in total to 147 million members. By average growth, I mean the average of every health plan's growth rate. Total reflects the change in combined membership of these publicly traded plans as a whole. Fully insured risk membership increased by an average of 47% and in total by 11% to 88.2 million members. Commercial plan membership, insured membership rather, increased by 5.6 million members to 57.4 million members. Notably, on a percentage basis among commercial plans, Bright Health grew by 293% to 891,000 insured members. Also, Anthem insured membership increased by 2.5 million members to 19.5 million. The primary driver was an increase in Medicaid membership to 10.4 million members from 8.6 million members previously. Medicaid plans experienced an average increase of 16% and a total growth of 13% to 23.7 million members. Medicare plans had an average increase of 42% with total growth of 9% to 7.2 million members. The proportion of total members served under self-funded ASO arrangements fell by 2.7 percentage points to 40.1%. On average, the plans posted a 2.2% decrease for this product, and ASO membership was down in total by 0.1% to 59.1 million members. Revenues for all plans increased by an average of 69% and in total by 13% to $181 billion for the quarter. Anthem revenue was higher by $4.9 billion to $35.6 billion. United Health was higher by $7.1 billion to $72 billion for the quarter. Commercial plans increased by an average of 97% and in total by 12.9% to $120 billion. Medicaid plans reported $39 billion in revenues, an average increase of 26% and a total increase of 16%. Molina posted the largest percentage gains in revenues for Medicaid plans, up 40%, in large part due to acquisitions over the past year. In the Medicare segment, plans reported $22 billion in revenues, an average increase of 48%, and a total increase of 8%. Humana's revenues increased by $1.4 billion to $22 billion. Included in the $1.4 billion increase was a $350 million increase in revenue due to the completed acquisition of Kindred at Home. Previously, Kindred at Home was held by Humana as a 40% minority interest, but on August 17th, it acquired the remaining 60%. Premium rates for all plans grew by an average of 2.6%. Medicaid plans and commercial plans experienced average premium growth of 7.1% and 1.9% respectively. Medicare plans' premium rates increased by 1.5%. Note that the premium rate growth does not adjust for changes in product mix, geographic factors, or benefit design changes within the products offered by these plans. Operating earnings for the plans in the third quarter totaled $8.5 billion, an increase of 47%, or by $576 million. Anthem, a commercial plan, had the largest change in operating earnings from $715 million to $1.9 billion, an improvement of 169%. Average operating margins for all plans decreased by 3.1 percentage points to negative 8.2%. This was due to the newly public plans that all had negative profit margins and an average of negative 24.9%. When the newly public plans were excluded, the average profit margin was 3.8% compared to much higher 5.4% in the prior year. The health benefit ratio for all plans increased by 5.6 percentage points to 89%. Similar to the profit margin in the newly public plans, they had a health benefit ratio of 93.4%, while the plans that were public during 2020 had a health benefit ratio of 85.7%. The average health benefit ratio for commercial plans was 91% versus 86% in the third quarter of 2020. The average health benefit ratio for Medicaid plans increased by 2.7 percentage points to 85.8%. Medicare plans had an increase of 7.8 percentage points to 87.9%. The administrative expense ratio increased by 2.2 percentage points to 19.4%. Commercial plans reported a 17.3% administrative expense ratio, which is identical to the third quarter of 2020. Medicaid plans reported a decrease of 0.5 percentage points to 13.7%, while Medicare plans experienced a 6.7 percentage point increase to 19.4%. Excluding the publicly traded companies, the established plans tell a different story in administrative costs. When looking solely at plans that were public prior to 2021, commercial plans had an administrative expense ratio of 10.4% compared with 12.8% in the third quarter of 2020. And Medicare-focused Humana had administrative expense ratio of 8.6% compared to 8.5% last year. The Medicaid universe's ratios were unaffected by the additional plans since both Centene and Molina were the only two plans in the universe both this and last year. Non-operating earnings increased by $889 million. Our calculation of the non-operating income is the sum of all investment earnings, income earned in non-health lines of business, less interest expenses. Medicaid plans reported a gain of $181 million for non-operating earnings, compared with a loss in the prior year's quarter of $102 million. Commercial plans had an increase of $262 million to a total of $1.6 billion. This was driven by Cigna's non-operating earnings of $1.4 billion relative to the comparable quarter of $1.1 billion. Non-operating activities includes its Evernorth subsidiary, which we know better as Express Scripts. Net earnings for the third quarter were higher for the plans compared to the third quarter of 2020. Net earnings increased in total by 24.2% and 33.1% on average to $8.8 billion. Medicaid plans had net earnings of $724 million, a decline of 3.5% from the prior year. Medicare plans had net earnings of $1.4 billion, an increase of 8.2%, and commercial plans had net earnings of $6.7 billion, an improvement of 33%. I want to close by touching on some key environmental factors. Uncertainty is the nature of healthcare and for the rest of the economy as well. Inflation trends and economic growth, including adapting to scale changes, are two of the uncertainties. I want to note several Sherlock Company research projects that may be helpful to you in sorting through this. Regarding inflation, we will complete our 27th annual premium rate increase study on Friday of this week, which may quantify some of the inflation factors. Second, regarding adaptation to scale, we also published our annual Economies of Scale study recently. The effect of employer adaptation to COVID-19 was a sharp decline in employment in the middle part of 2020, though it largely recovered by year-end. While it didn't have to happen this way, it could easily have created an operating leverage crisis for many health plans that serve employers. So we recently published our scale study for universes of Blue plans and independent provider-sponsored plans, as well as for the combined sets. We've provided the scale slopes and statistical significance for each function and subfunction for each of these sets. It is possible that these scale slopes can help you quantify the effect of changes in membership on changes in administrative costs for your plans. Finally, we have entirely completed our 24th annual benchmarking studies. These provide norms for administrative costs for the 70 functional areas in the numerous products, as well as staffing ratios and other operating metrics. There are universes of Blue plans, IPS plans, Medicare plans, Medicaid plans, and larger plans. Many of these resources are free of charge on our website. Please look at the Navigator reports and also for something called Test Drive that you can also find on our website. The detailed Economies of Scale study are included with a Pulse subscription. The premium rate surveys are also included with a Pulse subscription. The detailed benchmarks are available for license, or you can participate in any of these universes in 2022. Please let us know if any of this is of interest. You will be among good company. As always, you can get a transcript of these remarks through MCOL or Sherlock Company. We look forward to hearing from you. This is Doug Sherlock of Sherlock Company.
You've been listening to Doug Sherlock Shares quarterly insights into the financial markets of health.